We last talked in April, and we talked about permitting, regulatory challenges on the CCUS space. Has anything changed? What has changed over the past few months?
Well, great question. I would say that I saw some trepidation in the spring with projects, mostly in anticipation of the reconciliation bill, which became the One Big Beautiful Bill. There was a lot of concern as to how CCUS would be treated in that legislation, and we're happy to say that it was treated well.
Yeah.
The 45Q credits for carbon sequestration were maintained and increased. The rate of credit was increased for EOR and utilization to bring that rate in parity with permanent sequestration. So not only did that provide another financial incentive for CCUS, or an increased financial incentive, but it also gave people more comfort towards the administration's acceptance of and support for the CCUS industry. So that was really important. And following that, I've really seen a tremendous amount of confidence in the industry, more capital coming into the industry, and generally a lot of enthusiasm.
Yeah, and also it's something that we're seeing here in the conference, like full room for your session.
Absolutely.
So there seems to be a lot of interest in the CCUS space and a lot of variety on the players involved. So that's awesome. Are you seeing progress or just in general positive momentum on the permitting and regulatory side, not only on the incentive side?
Great question on permitting. Something that I addressed when I just spoke at the conference was less progress in terms of looking for pipeline regulatory guidance with respect to supercritical CO2.
Okay.
PHMSA already had regulations on gaseous CO2, but does not have an immediate plan to issue guidance on transport of supercritical CO2.
Could you elaborate just for the audience, like what's the difference between supercritical and gas?
And gaseous state. So the supercritical state is in a liquid state. It's highly compressed.
Okay.
So you need a heavy gauge of pipe. And that's what a lot of these projects were seeking to use.
Okay.
Was shipping supercritical, highly compressed CO2. That's most of the projects in the northern Midwest. A lot of those, as you know, had issues getting permitted. And when I asked our pipeline safety team, led by my partner, Catherine Little and Annie Cook, why is it if we saw Republicans effectively embrace CCUS in the One Big Beautiful Bill, and we know there's an eye towards permitting reform, why are we not seeing this guidance come out of PHMSA with respect to transport of supercritical CO2? And, their view was kind of two-part. One is, it's not that they think it's unimportant, but there are a lot of other priorities right now.
Okay.
They're trying to focus on those other more immediate priorities. And also, the general environment right now is not to add more regulations, but rather to try to reduce the regulatory burden. So, there's a little bit of a challenge. If you are going to add more regulations, are you going to take something else away? How can we make sure that this isn't an administrative burden? And I asked them, really what impact do they think it would have on the market of this guidance now being pushed out? It could be 2027, it could be later. And they said that's given a little bit of fuel to the opposition who say these pipelines are dangerous, because they can point to the fact that, they're not regulated, there's uncertainty about them, and it kind of supports their case in opposition. That said, I will say, as a commercial response to the lack of guidance, I've seen two things happen, right? You saw the success of the Tallgrass Trailblazer pipeline. That is a gaseous CO2 pipeline, and what they did there is they didn't build new pipeline for the most part. They repurposed an existing natural gas pipeline. They took it out of natural gas service, and they used it to ship CO2.
Okay.
So they were able to avoid a lot of these permitting requirements for these shipments of supercritical CO2. They're already shipping CO2, so this has been a huge advantage for them. Other people are looking at repurposing other pipelines currently in use for natural gas. You have to go through the FERC process to do that. Otherwise, I've seen projects really thrive where they're in close proximity to a sequestration or EOR or utilization site. I don't see many people now pursuing projects that are going to require long distance pipelines. Really, what I've seen is more capture localized with sequestration or EOR.
So it seems that the main viable options now are either you're repurposing an existing pipeline or you're close to the sequestration site.
Or you're relying on pipelines that for years have been shipping CO2 for EOR. That was typically taking CO2 from subsurface springs and shipping it for EOR. A lot of those companies, like Oxy, who have been doing that, are just now getting industrial customers putting their CO2 on that line.
Okay, perfect. So are there any other challenges thinking about, I don't know, cost, technology that are affecting CCUS project economics?
Right now, something that has caused concern is the potential repeal of the greenhouse gas reporting program.
Okay.
That's something that's administered by the EPA. It was built under guidance under the Clean Air Act. Now the EPA has taken another look at it and thinks that the greenhouse gas reporting program goes beyond their mandate in the Clean Air Act. And they're pulling it back, thinking it is, an unnecessary regulatory burden. The downside is the greenhouse gas reporting program is woven into a number of the federal tax credits for energy transition, including the 45Q credits for carbon sequestration. The requirement for permanent sequestration is that you have the appropriate underground injection control permit and abide by the applicable rules under Subpart RR, which is under the greenhouse gas reporting program. So when these announcements or the anticipation of this repeal first came about, there was a lot of concern among my clients as to whether this was kind of a backdoor way of getting away from the CCUS federal tax credits.
Yeah.
We did not think that was the case. In fact, we knew the EPA had a completely separate purpose for pulling back these reporting rules. But there's still, a fair amount of concern, if not those rules, what? So there was an appeal to the EPA of can you keep those rules standing for purposes of federal tax credit qualification? In their announcement a couple of weeks ago, the EPA declined to do that. They didn't think it was within their mandate under the Clean Air Act, and they didn't think it was part of their mandate to be holding up these regulations for purposes of the federal tax credits. Now, the Treasury Department has known about this potential repeal for some time. So we don't think that when the repeal actually occurs, that there will be a gap and people won't be able to claim 45Q credits. We do think in the interim that guidance will be established for how to comply with operating and maintaining sequestration sites. There's just a little uncertainty right now as to what that will be. So that's causing a little bit of consternation, particularly with banks that are looking at financing these projects. It's very tough to tell a bank, look, we don't know what the requirement is going to be. It's going to be different. We're going to have to figure out who's going to administer it. But we know there's going to be one, and we don't think it's going to be, there's an intent to make it more onerous. They like the certainty. So even in light of this potential repeal of the greenhouse gas reporting rules, I have seen projects moving forward. I don't see people stopping the progress. I think they are reasonably comfortable that, there will be a replacement for the greenhouse gas reporting rules within Section 45Q. Not clarity yet as to what that is going to be. We don't think that there is an intent to be more onerous or disqualify people for the credits who would qualify now, but it's just a wait-and-see approach. I would say while it creates some uncertainty, I don't think it's creating fear in the industry.
Okay. So that's not stopping investment from happening overall.
No, but everybody would like clarity sooner rather than later.
I think everyone would like that. And actually, this is tied to my next question about uncertainty at this point is inevitable, right?
Yes.
So what are your clients doing in the face of that uncertainty? Like on the renewable side, it looks like scenario modeling and just trying to figure out how much money you're going to get from your project depending on the incentive available, how much the equipment costs, tariffs, so on and so forth. How does that look like in the CCUS space? Is it similar? Like a similar approach?
Yes, absolutely. So what I see my clients looking at is, the cost of the CCUS equipment. In some cases, if you're adding it to an operating industrial facility or even an industrial power generation facility, there's a question of how much downtime will that result in? Also, if they have a lot of demand for their power, whether it's the product they produce or the power that they're generating, there is some concern as to whether CCUS equipment, which like all other equipment has to be maintained, there has to be some necessary downtime.
Yeah.
Will that impact the deliverability of their product?
Yeah.
What risks does it add? If they're going to incur this significant cost, what are the benefits they're going to receive? What incentives? Obviously, if it's just a pure play CCUS, it's the 45Q tax credits, maybe some other environmental attributes, voluntary carbon market credits. But when you're decarbonizing another industry, such as clean fuels, you might make that fuel that's being produced eligible for the 45Z federal tax credits. Mm-hmm. It also may be eligible for other state programs like the California Low Carbon Fuel Standards credits. So you have to look at all the different incentives that are available, weigh it against the cost, and also if you're producing a cleaner, greener product, for example, decarbonized power, you're very likely to get an additional premium for that product.
Yeah.
So you really have to take all those factors into account in contrast with the cost CapEx spend for the project, as well as the cost of any fees for transport and storage, which is a long-term arrangement, and any additional maintenance cost for all of that as well.
Yeah. And there's also this component on risk, right? I just had a conversation with Omer from Bank of America, and he mentioned like one key piece to consider on the risk side is risk of leakage, which is something that you don't really have in the renewable side. Well, you have losses, but yeah, that's already considered as part of the normal operation of the asset. But in the particular case of leakage in CCUS, you're going to lose that incentive. There are different elements to consider as part of that risk mitigation process.
Absolutely. And I've spoken to a lot of banks about the recapture risk. And that is if the CO2 that is stored subsurface leaks into the atmosphere. And if that occurs, you can have a loss of tax credits. On a LIFO basis, you treat that CO2 as if it hadn't been stored. So for a lot of banks, this is really a new area, right?
Yeah.
Understanding the geology of the storage. And there isn't a lot of storage data. We're getting more and more every day.
Yeah.
But there isn't a lot of data about storage of CO2, whether it's likely to leak, whether it's likely to migrate. It can migrate and come up through, other abandoned oil and gas well sites. It's very site specific. So that's a whole new area for them, is understanding the geology risk. Fortunately, insurers have stepped in to fill some of that gap. And there are insurance policies that are available to insure against the risk of recapture of credits if there is leakage or any other penalties or violations that might occur that give rise to a leakage of CO2. Years ago, there was a hesitancy to pursue the insurance because the premiums were so high.
Yes.
Obviously, the insurance companies were also getting up to speed on what is the geologic risk, but they are coming down. So I think that is really helping projects move forward, not only in getting financing, but also monetizing the credits.
Okay.
So that is moving around along. I think people are getting a better handle on it, and really more long-term data as to whether that CO2 stays in place, what factors they look for that might, pose a greater risk, and whether that CO2 is calcifying underground, reducing the risk that it would leak in a gaseous state.
Okay, perfect. We touched on the challenges. You already started talking about some elements or changes that are happening in the market that are allowing to have more CCUS deployment. Is there anything else happening that is precisely helping see more CCUS projects on the ground?
Again, I think the One Big Beautiful Bill gave a lot of people comfort for support of the industry. I think there's just more experience. There is more now liquidity in monetizing the 45Q tax credit. Banks, insurers are becoming more familiar with it. I think we see developments in the voluntary carbon market, registries being more familiar with CCUS operations. I just see a greater comfort with the technology. Originally I really saw it adapted in pre-combustion capture, ethanol facilities, gas processing facilities, and that was the vast majority of my work. Now I'm really seeing much more on post-combustion capture, on gas-fired power plants, and these deals are closing, and it really gives me a lot of belief that this is going to go broader scale much more quickly.